Good afternoon, everyone. Thank you very much for joining us today. We're glad you're here. My name is Bill Kennedy. I'm with the New York MBA's Education Committee, along with the Education Committee Chairperson, Elizabeth Cheney, the president of our organization, Sherry Eccles, our executive director, Joe Culver, and the rest of our board. So before we get going, a couple of things. I want to highlight one of our most important in-person member events coming up in a few weeks, and that's the New York MBA's Advocacy Council conference, I should say, March 3rd and 4th in Albany. I don't know how many in a row I've been to, but it's a great event. You get to learn what's affecting us, where we can make a difference with our representatives, and there's a information session day one, and then a chance that evening to meet in a social setting with our representatives, and then the next day we go on up into the Capitol and meet with our senators and assembly people. So please visit our website, newyorkmba.org, and register to attend the Advocacy Council. It matters, and we appreciate your input. Before we get started, a few housekeeping notes. Please use the chat function to notify us of any technical issues you may have. During today's webinars, all lines are muted except for our presenter, and that's Bill. Throughout the session, you'll have the opportunity to ask questions. Please use the chat to do so, and we'll do our best to address as many as we can in the QA session at the end. We'll be sharing the presentation slides and relevant resources with you after the webinar. Always stay connected with the New York MBA. We're on LinkedIn. Our website is nymba.org, and our YouTube channel is where we post the recordings of our webinars. That's at New York Mortgage Bankers Association. And we always urge you and all mortgage professionals to join the Mortgage Action Alliance. It's easy, it's free, and it's a way to stay informed on legislative issues that impact the way we do business. But you're here today to hear how to read the markets with Bill Bodnar. Bill is the Chief Revenue Officer, which is a great title, of Tabrasa and the driving force behind the Mortgage Market Guide. This is the industry's premier source of mortgage and economic intelligence. Bill has been delivering insight for the industry for over 25 years. He's a highly sought after speaker and a trusted voice for our industry. Please welcome Bill Bodnar.
Hello, thanks for having me. It's great to be here, and it's nice to have some local cooking. I grew up in Staten Island, New York. I'm out here in New Jersey, so I am freezing with you here. Hence the vest and the long sleeve shirt. Can't get warm. I'm ready for spring, and I didn't like Punxsutawney Phil telling us we have 6 more weeks. I'm ready for it tomorrow. But we're going to talk about reading the markets. And I run a company called Tabrasa. And one of the products is Mortgage Market Guide, which in April will be 25 years running that solution. And so what we do is we help thousands of originators kind of walk through what's happening in the economy, the Fed, the markets, the charts. So I'm going to walk through all of it. And as I do, what I encourage you to do is think about whether it's for yourself or you lead a team, what an opportunity to better understand the markets and make it relatable. Not necessarily into forecasting and so on and so forth, but at least be able to be like an umpire, right? Establish a market position, be able to call balls and strikes. Where are rates headed? Why are they headed that way? What's next, right? And you keep your clients and your partners on edge because, I do this talk I'm going to do now. I do on behalf of lenders, do this for realtors and builders constantly, and they eat it up. And so let's go through it. Let's have a little fun. And if you're interested in learning more, let's connect afterwards. So, let me go. Here we go. First slide. So we got to also remember before we even get into it, one of the things, just philosophically, as we kind of go into this year, last year, the media, you have to remind yourself, another reason why this is important is the media is not your friend in all this, right? It doesn't say, hey, Bill, thanks for tuning in. Things are great. See you next week. It's always doom. There's always fear. Remember, fear sells. And last year, in the face of, a pretty darn good year for the mortgage business, they told us stagflation, recession, tariffs are going to be horrible. They're selling America. Sell America, trade is on. It was all a bunch of garbage. None of it ever manifested. And mortgages, just mortgage-backed securities, that bond, had its best year in like 15 years, right? So I push back on a lot of the noise and I look at the action. You're going to see here, I'm again, like I was last year, optimistic, but I try to root it in reality. So let's talk about it. Another reason why you need this is that artificial intelligence is a big deal. So that RI is real intelligence, right? At least understanding the markets. When I look, loan officers will never be replaced by AI. But the ones that don't bring value, yeah, they could get replaced pretty quickly, right? And so this is an area where, but couple this with some emotional intelligence, I don't know how you can lose, right? Because AI is not going to get there. You got to be able to walk people through this stuff. And so I put this image because here's a woman cleaning an iRobotic, place with a mop, and ironically, that iRobot just went bankrupt. So let's push forward. The Creature from Jekyll Island. I'm a market guy. I've been doing it for a long time, over 30 years. And I got the ability to go to Jekyll Island and see where the Creature from Jekyll Island was formed. And what is the Creature from Jekyll Island? That's the Federal Reserve, right? In this room, the Federal Reserve room, those 6 individuals, those were big banking guys and powerful people, plus a big senator, came in and secretly met using only their first name, making believe they were on a duck hunt. They created the framework for what would be the Federal Reserve just 3 years later. So for me, it was fascinating to visit all that history, and not all of it's great. So we're going to talk about a new Fed in a moment, but we got to talk about Mr. Powell, because while the Fed doesn't influence mortgage rates with their hiking and cutting, they could certainly help or hurt us. And they hurt us a bit. His legacy has a bit of taint on it, because when we go back to 2020, when he purchased mortgage-backed securities to stabilize the market, that was a great thing. The problem, he probably did it to a year plus too long. So what he essentially did by buying mortgage-backed securities for maybe a year plus too long, he fueled the demand side of the house buying equation, which didn't need any demand, right? Everybody wanted to own a home, and the lower rates just pushed prices to stupid levels and really created a lot of dislocations that we're still fighting with today. So, with inflation, with housing inflation being an outsized portion of overall inflation, when we look back and say, how did it go? The fact that he called inflation transitory right up until when he was renominated, then a week later said, it's not transitory. He's got a lot of stains on his record. And so we're going to move on from him. But we got to remember that, he really didn't do a lot of great stuff for us. And it was even last year, right? Last year, we had tariffs, right? A lot of tariff uncertainty. And back in March, I love the internet. You can capture all this. As these things were dropping, he said, wait, folks, hang on. This pain from tariffs will be a one-time price bump, and its effects will be transitory, short-lived. I don't know what happened. Right? Maybe they hit him over the head. Somebody with an axe to grind said, Jay, you can't say that. And he never said it again. And so Karen and I have 6 kids in our house. And I remember when they were little, 5 or 6 years old, they might say something pissy like this. Well, I would have cut rates if it weren't for tariffs. Now, remember, in March, he said, it's going to be a one-time price bump. All last year, there was no inflation. By the way, tariffs would never create broad-based inflation. He said it wouldn't, and I didn't believe it. I think the bond market wasn't believing it because the rates just went, nothing would go lower all last year. And the reports weren't showing it. Yet he said this. Then between July 1st and like SpongeBob, remember SpongeBob? Like a few moments later, 6 weeks later, he's right back to where he was back in March. A reasonable base case is that the effects of tariffs will be relatively short-lived. He wouldn't dare say transitory. He would have gotten eviscerated. It'll be a one-time price shift, one-time shift in the price levels. And so he really missed it on it. Now, why is it important? Well, because when you look at rate cuts, they don't have to be inflationary. Remember, they don't hit the economy for 6 months. You can make a good argument that they should have been cutting still. And more importantly, we have this debt and deficits problem, right? If we had the Fed funds rate 0.5% lower beginning of last year as opposed to later in the year, we essentially lit a match to tens of billions of dollars just in interest rate payments that we could have saved for. So it really stunk that he did that and drug us through that, and it was unnecessary. There was no need to keep rates 50 basis points higher. Now looking back, just it didn't have to happen. And it shouldn't happen, but changes are coming. Before we get to where we are with the new Fed, I want to talk a little bit more about some of the things that the Fed does. In addition to hiking and cutting rates, every 3 months, they give us their summary of economic projections, where they see growth, unemployment, um, inflation, and the dot plot. And I can tell you this, all last year, they overstated or understated economic growth. So every time they gave us growth, they kept inching it up. You can see 1.6 became 1.7. Early in the year, it was 1.4. It's probably going to be closer to 2% when it's all said and done. And then on inflation, they said it was going to be 3.1%, then it's 3%. I'm not sure core PCE is going to have a three handle. So again, they told us all last year, right in our face, that growth is going to be slower than it was, and inflation was going to be higher than it is. It's kind of bad to miss it on only a couple of items. You only have four things to watch. They missed it on a couple of them. And so the Fed has a lot of division. It isn't just the president versus Powell. It is Powell's group of 19 officials. Even just a couple months ago, they went and said, where do you see rates? All right, you have 19. 10 voted back in September for a cut in December, and 9 didn't. It just shows, like, going into where we are now, it's very, very divided. And it's interesting because it's about as divided as the Fed has ever been itself. And back in the day, if Mr. Culver on the call here was a Fed chair, if he said we're cutting rates, everybody kind of like ducks. They kind of just march in line and say, yeah, let's kind of do it. Now everybody is also independent thinker. They have their own thoughts. And it makes our world crazy, because when you have 19 Fed officials all talking and telling their opinions, and they're all over the place on where they see monetary policy, it makes for a lot of volatility and uncertainty in the mortgage banking world and in the overall economy. So I hope this gets reeled in with the new Fed chair. Now, when I said it's divided, don't get distracted by Mr. Rod Stewart's mullet. But I wanted to pull this chart because, the first cut was the deepest. That was a 50 basis point cut last year, 2 years ago. We're not going to see a 50 basis point cut. But what I do want to show you is the dot plot. And the dot plot shows where do these 19 officials see rates, even though not all of them vote. Essentially, anybody on this call has an equal chance as the Fed to tell us where rates are going to be, because they said it's going to be anywhere from 2.5% to 4%. That's a pretty big, that's like a goalpost, right? We got the Super Bowl. That's like a goalpost being as wide as like an airfield, right? You're not going to miss. Somebody's going to get it right. And so let's hope that they get this tightened up and we get more unity as to where the Fed is. That's a big deal. We are living in a low neutral rate world. You may remember the gal on the right, on the left, she lived in a material world, but the guy on the right is Fed President New York Williams, and he said we're living in a low neutral rate world. What the heck is that? Well, the neutral rate is a rate, that the Fed funds rate, that neither helps or hurts the economy. Right now, our Fed funds rate is 3.5 to 3.75. It is arguably restrictive. It's still tamping down that last little bit of inflation, but not necessarily elevating the unemployment rate. Eventually, we'll get to a neutral rate or a terminal rate where we stop cutting rates. That we're going to get to a spot that's called the neutral rate, right? The terminal rate is when we stop monetary policy and we let things sit. That rate is called the neutral rate. And there's debate as to what that is. Right now, a lot of Fed folks and others think that that rate is 3%. Hence being, there's no fighting that we need to cut rates. The fight is, how fast do we get there? And right now, they're saying it's one cut this year, one cut next year. We get the Fed funds rate to 3%. He says, hang on, Charlie. We live in a low neutral rate world. Again, what does it mean? Well, he's telling us we're going back to a neutral rate that existed before the pandemic, when we had really low inflation. He's saying that neutral rate is probably somewhere like 2.5. So he's saying, don't be surprised, instead of cutting 1 to 2 times, that we go anywhere from 4 to 6 times over the next couple of years. Very interesting. And the reason why it's important is because Mr. Williams is a forever voter. Unlike a lot of Fed officials who get rotated, every 6 months, he's always there voting. So he's one of the more important vocal voices of the Fed. Listen to that story as we go forward. Watch the neutral rate. Another thing that we're seeing amongst Fed officials that has happened near term, that is just, I keep my ears up and I listen. they talk about this third Fed mandate. And wait, right? We were always taught the Fed has a dual mandate: promote maximum employment, maintain price stability, right? Just inflation and the labor market. But wait, in 1977, after a year that was not unlike what we went through, stupid energy prices, really high inflation, high mortgage rates, people were really miserable. Uh, they demanded the Fed do change. And so they brought Congress in and they made an amendment. And they said, we need to do one more thing. We need to also make sure we have moderate long-term rates. I haven't heard this phrase. We haven't heard this phrase probably since they created it, nearly 50 years ago, but it's back. And so listen for it. What does moderate long-term rates mean? I don't know. I don't know what the rate is, but I like the fact that Fed officials are talking about it, because last I checked, we're trying to sell long-term rates, and the last thing we need is high. We need the moderate to low so we can help move stuff, right? So I'll be watching for that in the months ahead. I also say a lot, and there'll be a lot of opinions. There's no shortage of them. People say things on the media, a lot of crazy stuff that I push back on. But what I do is I watch the bond market. I think the bond market's the smartest person in the room. And I also look at poly market, because that's real money being bet, right? There's a lot of opinions, a lot of pundits on TV. They all make noise. I look at the markets, and poly market sees the next rate cut coming in June. And that right now is no longer 70%. It is a coin toss. So that will change. And that's because some of the economic numbers that have showed up lately have been better than expected. So let's talk about the next Fed chair. By the way, I was just on another call with a big bank in Indiana right before this, and they were asking me, what's the chance that he gets in? It's pretty much 100%. The idea that he's not going to get in, they're going to have total chaos. It'll be a circus and this and that, but he's going to get in. What does he stand for? Well, it's important to know where he's been. He has been on all sides of this. He's worked internationally, he's worked on the Fed and whatever, and he was really, really critical. He quit in 2011. He left the governors. He said, you guys are losing your mind. All this quantitative easing, you're getting into like mission creep. Again, you have two mandates: inflation and unemployment. What is this buying bond crap and supporting housing and going crazy? And like, that's got to go on the fiscal side of the house. That should come from the administration and treasury. So he really pushed back. And so what does it mean now? Well, we have this balance sheet that we've amassed over the last, since almost 20 years, since 2008, the Great Recession, because of all of our bond buying. And we still have 6.6 trillion. He wants to get rid of it. Now, it's not going to happen overnight, but he wants to get rid of it. That motion, he wants the Fed out of bond buying, which I think is really good, because it creates a lot of noise. And so in the markets, a lot of volatility. And as we've seen, it's created a lot of housing inflation, which we didn't need. Again, if the Fed's buying and lowering rates, that just creates, subsidized rates, which creates inflation rates that are higher than we need. So if you're shrinking the balance sheet, this is taking money out, and it's tightening financial markets a little bit, tightening the pipes. But at the same time, what he's doing is saying, hey, well, we're going to cut rates for Main Street and small business, right? Where we need relief: small business, consumers, HELOCs, credit cards, home equity, auto loans. So we need lower rates for Main Street, and we want to do this and preserve growth. If you look at that number 5 bullet, this is probably the most important thing. That is a complete departure from where the Fed has been. Every time, and you're going to hear it. I promise you're going to hear it. And you say, Bill said that in this call. The Fed always talks about, we're worrying about the economy running hot. And I've always questioned, what the heck does that mean? Because it's almost like a feeling. Like, what does it mean running hot? There are no numbers, right? Does growth have to create inflation? Well, look at the housing market. Over years, we've sold a lot of homes. We've had years that were incredible. Why were they incredible? Because we had a lot of supply. We also had a lot of demand. We had a lot of balance in the market, and we sold a lot of homes. That's exactly what we can do in the economy. So his argument is, if we can lower interest rates so that small business and Main Street can create a lot of goods, a lot of stuff, a lot of supply, and that supply gets sopped up not only is it not inflationary, but it's disinflationary, very much like you'd have in the housing market. Instead of housing prices going up 20% a year, which is stupid and we can't have that again, they grow up single digits, maybe even low single digits, which is fine. But then it takes affordability and doesn't make it a problem that we have to deal with like we did now, where we have prices rise 60% over a 5-year period. So it's a big deal, and he wants the dollar strong, and that created some ripples, right? Made gold get punched in the face, had to take a pause, and so it'll be interesting. Is he going to get nominated? Absolutely, and it's going to be a departure. One of the other things that's going to happen. We have 400 or so PhDs at the Fed, and I don't, I'll say out the politics of it, but the reality is, Fed's been late. I won't go blue red. I'll talk green. Like they've been late. They were really late. Not only late on inflation, but goodness, folks, they were late on cutting rates, right? They started with 25, then they went 50 basis points. They said, oh, crap, we got to do 75. Then he got on camera and said, folks, 75 might be it. It would be really cruel and unusual almost to do more than 75. They hiked rates by 75 4 times. So, I've lived through this, and I know that, it's been very, very noisy. We got to get back to some sanity in the room. And I think what's going to happen is he's going to maybe look to shrink the size of the Fed, maybe get rid of all these economists and make things skinnier. Who knows? There's AI, there's quantum computing. Maybe we can get better with technology to do things in real time to see how the economy is doing and not react to backward data. And that brings me to this slide. Maybe there's an alternate measure of inflation. The left is a thing called trueflation. The right is CPI. Now, CPI and trueflation are saying inflation is a lot different. CPI is running 2.7. Trueflation is running in below 1%. Why? Well, the one on the left is real time. It's not backward-looking, lagging data. There's the one on the right is 80,000 surveys. Can you imagine painfully getting surveys? How slow and lethargic it is to do a survey. Also, how noisy it could be. A survey is like a poll, right? Like, when the cops, when they go to an accident and they see an accident and they ask 20 people what they saw, you're going to get 20 answers. Can you imagine aggregating a survey on inflation, labor market? It adds a lot of noise. And so they're using 15 million sources doing it in real time. Sounds a lot more accurate, right? And the weighting on housing is different, which is a big deal. So their inflation numbers running a lot lower. And one of the reasons why CPI is kind of interesting is look what they don't include. I mean, they don't even look at housing as, even though housing makes a big piece of it, they treat home ownership as an investment rather than something you consume. So they basically exclude mortgage, which, we know mortgage is a huge part of the equation. So they exclude mortgage payments, mortgage interest rates, home price sales, right, which seems valid, down payments, all that stuff. So it's just interesting. We're going to see if we get alternate data sources for the Fed. I'm going to move past this slide. I'm optimistic about inflation because of housing. Housing makes up 41% of CPI, almost 20% of core PCE. And recently, the owner's equivalent rent that it's what you and I think we could sell our home for. That came in at the lowest level in 5 years. That's an unbelievable data point, right? And it was a headwind for us for the longest time, meaning that those numbers were stubbornly high, and it made inflation high, and it's why the Fed kept rates higher for longer. If that is now falling, it means the Fed's going to have to get out in front of it and cut maybe more than expected. So we're going to find out, right? You can see the spread between 30-year mortgages in blue and inflation in red. We're now at 340 basis points. It's wide. And you can see here pre-pandemic, it was like 200 basis points. So, if we can get rid of this fear of inflation, and a lot of it, folks, is related to debt and deficits, we can have 30-year mortgage rates just start to come down kind of organically between, mortgages coming down and 10-year coming down, because they see, yes, inflation is indeed moving in the right direction, but it's all related. It's where inflation's headed, as well as where, our debt and deficits are. That's probably the biggest headwind that we have as it relates to, lower rates. And right on cue, turning Japanese, remember that great song by the Vapors? You have to watch what goes on around the globe, not just what happens here with inflation, GDP, our interest rates. The bond market is global. And that chart that I have there, 364, that's the Japanese 30-year bond. It seems low at 364, but that's the highest level ever. And so when you see our 10-year note at four and change, it puts upward pressure on our rates. One of the reasons why our rates have perked up over the last couple of months is because bonds around the globe are moving higher. The bond market's global. In Japan, they have the highest rate since 2011. I'm sorry, in Germany, their Bund is at the highest level since 2011. In Japan, their 10-year note's the highest since 1998. So you're going back really far to see these high rates. And why? Same problem. Really bad fiscal policy and very bad makeup. They're trying to lower taxes and do all this spending, and the bond market is looking at this and saying, guys, the math is not mathing. You can't pay this back, and so we got to charge you higher rates, which makes things even harder. So it's a burden, and so it's not easy, right? We took on a big load of debt and deficits over the last few years, and I just hope, and you should hope, that Scott Bessent and the Treasury and the administration is successful in at least getting the bond market to give us time to get that house in order. Because if it doesn't, I'm old enough to remember what happened back after the Great Recession, right? You looked at bond markets like in Greece and Portugal, folks got priced out of the bond market, right? They literally, all of a sudden their rates went to 10%. They couldn't borrow and they had to go for bailouts. That's what happens. And the bond market's pretty strong. So I encourage you to watch the bond market and what things, how it digests the news of the day. I talk a lot, I talk fast, I know, but if you get just a couple nuggets, this is one, because I've been talking about this for 25 years, and I'm always vindicated. 30-year mortgage rates and 30-year mortgage rates and oil ebb and flow together. 30-year mortgage rates and oil ebb and flow together. So look at where we were in 22, right? Oil went to 120. It was terrible. It led to 30-year mortgages going higher right after it because we had inflation. Didn't move in lockstep, but it moved. Over here in 23, oil went from we got it down in check, strategic reserves, remember? And then all of a sudden we went from 70 to 90, and then 30-year mortgage rates hit 8%. That was not fun. And then we got more in sync. In 2014, oil and 30-year mortgage rates hit 2024 lows within the same 48-hour period. Pretty remarkable. And then in 2025, oil hit $81 a barrel. You can see here, just over 81. 30-year mortgage rates peaked just above 7%. And look at how they moved in lockstep together, lower over time, right? So that brings us to today. Why is it important? Well, if you think our energy policy is such that we're at least not going to allow oil to get back to the 90 and 120s, and I just don't see where that happens, then that means that it's going to put downward pressure and disinflationary forces in place, which means it's going to allow the Fed to cut more, which means it's going to allow for long-term rates to move lower, like mortgage rates. It's a good story. So we do need oil to be low if we want mortgage rates to go low. If it goes higher, it just puts upward pressure on it. It is what it is. And so we'll be watching that carefully, but I think we're in a good spot. And you can see here, we did this chart for our mortgage market guide members. You can see how they moved and they disinflated together, 30-year mortgage rates all last year, and 10-year note, 30-year mortgages and oil moved lower together in lockstep. I like to follow smart people. Lawrence Young is one of those guys at NAR. He said rents are decelerating and it will reduce inflation and encourage the Fed to continue cutting rates and pulling back in quantitative tightening. Well, quantitative tightening's done, but it's going to come back, right? But that means they're probably going to have to cut some more, which is a good story. So we're going to get both. We're going to get rid of the Fed out of the balance sheet game, and I think we're going to get more cuts than previously thought. And one of the reasons is because of this shelter component. It is coming down. Rents are coming down. Shelter inflation is coming down. It means the Fed's going to have cover to cut. They're not saying it now, but it's probably going to come, and it's going to catch potentially many by surprise. We're going to find out. I'm going to touch on this because it's worth touching. There's hard data and there's soft data. Hard data is GDP, inflation, labor market numbers. Those are things you can measure. Soft data is consumer sentiment, like a poll. And within these numbers, believe it or not, there's actually a political component, even on the inflation side, which is crazy. And it makes you wonder, what the heck are we even looking at that? If there's politics inside a number on inflation, why is the Fed even looking at it? It's kind of crazy. So let's talk about it. So they asked in this survey, would now be a good time to buy a home? And the home buying conditions had a 40 to 50% gap between Republicans and Democrats. It was the highest in 70 years. Isn't that crazy? So it just shows that that's noise. You just almost can't even listen to it. And then right after the election, 24, Republican home buying sentiment shot up to the highest levels since the 90s, and Democratic sentiment shot to the worst levels in 2008. But in the 2 week period when they did the survey, nothing happened. Mortgage rates didn't move. Home prices didn't go anywhere. Nothing happened. Yet you had all this noise. Stay out of the noise. Stay out of the fray. I would encourage you, instead of looking at consumer sentiment, look at the action. Like the old saying, actions speak louder than words, right? It's kind of like when they do a survey to a buyer in a mall. Hey, Bill, how do you feel about things? Oh, yeah, kind of sucks out there. I'm worried about inflation, this and that. And meanwhile, I walk into, Marshall's and I walk out with 12 bags of goods, right? You can't have both. So you got to look at the action. And here's the action that we watch at Mortgage Market Guide. Number one, we need rates lower. We have seen since rates peaked at 8%, every time you get a downtick in interest rates, we start getting action. Last year was a pretty good year, despite rates really not getting beneath 5% for any sustained amount of time. But now we're down at 6.25% to 6%. That's one nugget that we need. The second, actual loan applications. The MBA gives us these applications every week. If those are rising every week, people are in motion. Tell your clients, remind your clients. Remember, there's a media effect, right? They're lagging and they're not really quick to tell you good news, right? They tell us rates are lower a week later. And by the time they tell you, like the last little decline in rates, it's already over. So you got to get out in front of it. The other thing you want to watch is pending home sales. When those start to tick up month over month positive, folks, we're in a full-blown different housing market. So the last December pending home sales was not good. But one number doesn't make a trend. But the one in November, yeah, look at Jack Nicholson. He agrees it was the best reading in 3 years, right? And so the housing momentum is building. The data shows the strongest performance of the year after accounting for seasonal factors and the best performance in nearly 3 years. So the December numbers stunk. So there's noise. But watch those things. Pending applications, pending home sales, and mortgage apps are things to watch going forward. Now, the guy on the left, housing affordability. All right, the guy on the left, yeah, the 40-year-old virgin is not a great data point to be a first-time home buyer, right? Because that's what it was. The average age was 40 years, not real good. But how did we get there? Well, first is we're 4 to 5 million homes short. So when you have limited supply, puts upward pressure on prices. 54% of people say no matter what rates do, I'm not moving. I'm not sure about that, but that's a problem. 60% HPI, that's the home price index. Home prices rose 60% between 2029 and 2025. Wages only rose 30. And of that, pretty much got eaten up by inflation at 27%. So you can see why people pretty pissed off about affordability. They got clobbered, right? And a lot of that falls on Powell's lap for buying bonds too long. Another problem with this, it created a hidden tax. Insurance up 73%, right? That's crazy. And the first-time home buyer only made up 21% of home sales, where they normally are double that. I think this year is going to be better for a few reasons. One, 6.5% mortgage at 30 years, 100 million households can't do it. Well, we're lower than that now. And I'm not going to profess that we're out of the woods. I'm not going to blow my tuba here, but there's some things that are happening. Number one, and this is a cool data point. This is going to be the first year in 15 years that wages rise above the rate of home prices. Think about that. Home prices are going to rise by maybe 2% across the country. There'll be hot pockets here or there. Wages are going to be north of 3%. That's the first time in 15 years. That's a cool story, right? Then there's some things that we're going to see. We're going to see regulation reforms. I think we will see LLPA adjustments at some point, things that are meaningful. I think we are going to see a baby build. Some rumors are out there. Nothing fixes our affordability problem like homes, right? And the reason being, it is a massive economic, societal, and political issue. It's got to get fixed, right? We need homes. We need to produce homes. So I think it's going to happen. But every quarter rate and decline below 6.5% helps an additional million families. So here we are closer to 6, right? It's a good story. Scott Bessent, this is a guy to follow. If we want lower mortgage rates, it comes from this side of the policy. The Fed can help, but it comes from fiscal policy, which leads right into the Treasury Department. Now, Mr. Bessent, the bond market is digging him. That's not me saying it. It's the bond market. Again, there's credibility. Why? Because he speaks pragmatically. He doesn't talk about stupid crap. He talks about paying down the debt, right? He said, when asked on this interview, what are you going to do with the tariff revenues? And without missing a beat, he said, I'm going to pay down the national debt. Think about that for a second. If I went to you as a borrower and they said, here's my numbers, and they said, Mr. Bodnar, you got too much debt. Well, if I figured it out real quickly, right, maybe more income or whatever it looks like, I paid down the debt, you'd be like, oh, wow, look at that. Well, not only can I do a mortgage for you now, but hey, you can get the vanilla rate. That's exactly what we want. We want the vanilla rate in the bond market, and that comes from getting your fiscal house in order. What we should only hope as mortgage professionals is that the bond market gives this gentleman enough time to figure it out. He's gotten 1 year of runway so far, and this is not me saying it. This is the bond market saying it. We are like literally the only 10-year note on the paper, on the planet, lower in yield over the last 13 months, right? This is a 10-year note. It's not 4%, it's 4.25%. But if you go from January of last year to now, it's the only 10-year bond on the planet lower in yield. Japan is at the highest yield since 1998. Germany just hit the highest level in 15 years. So again, when things happen, weirdness happens. When we came out of the Great Recession, we were the cleanest shirt in the dirty laundry. Here we are now dealing with debt and deficits. Again, we're the cleanest shirt in the dirty laundry. Do not bet against America. Those knuckleheads that said there was a sell America trade last year could not have been more wrong. They could not have been more wrong. And you only have to look at what I'm showing you on this page to tell you that the sell America trade was a complete joke. It was a narrative. It was stupid. I don't know. It was political, whatever you want to call it. But folks that bucked it won. And the mortgage business won. Mortgages won because we had the best mortgage year in 15 years because people were not, it just wasn't happening. There wasn't a sell America trade going on. And there's not likely to be one. Here's a guy betting on America. This guy on the left, Warren Buffett, you can argue he's on the Mount Rushmore of investors. So when he decided in August to plunk $1 billion into Lennar and D.R. Horton, I could tell you one thing, he's not in it to lose. He's betting on a new housing boom. Well, what did new homes do? From 2019 to 2022, they went straight up. Builders were building like crazy. Then mortgages hit at 8%, thanks to all the crap that we did with inflation. And then builders stopped, and we flatlined for the last few years. It's reasonable to think that we go, boom, back to pre-level buying. So he's buying on the come. Great story. So upon that, here we are right on cue. A couple months later, Lennar CEO, where he purchased, was meeting with the administration. In an interview, he said, do you think something will come out on affordability in 2026? He said, I'd be surprised if something isn't done. What's interesting, he goes on, what's interesting is that the government has been very tuned into the industry to make sure they're not walking into unintended consequences. So whatever is done has to be constructed properly. It's important. Obviously, details and execution is key. So not every idea is a good one. I didn't put the 50-year mortgage up here. I think you can keep that one. But the idea that we could stop Wall Street from buying homes in mass in hot areas, that helps. Again, everything has to be so stupid and political. At the end of the day, if you could stop even some folks to buy, like getting in the hot areas, that's a good thing. If you buy mortgage-backed securities, it's not going to have an effect. Well, it already tightened the spread between 30-year mortgages and 10-year note. Thank God, because rates would be a lot higher if they weren't. And then lastly, he met with home builders to adopt affordability. And maybe that's why some of this idea of building entry-level homes are out there. So at the end of the day, I'm excited that we're hearing ideas. Not all of them are good, and not all of them are a magic bullet, but directionally, they all help with housing, and it's a good thing. And we need good housing to have a good economy. Every time we build a single-family home, we create 2.9 jobs. And maybe we need to doge the amount of government revenue. Look at that, $129,000 in revenue per home we build. That might be a little bit too much. Maybe we need the government to not take their fair share, right? That seems like a little bit more than their fair share, because that equals about 25% of the cost of a single-family home. So if 25% of a home is just regulatory burden, we need to look at that and streamline that. And I think that may be coming. The mortgage spread. If you don't know what the mortgage spread, give a listen. This is good stuff. So there's a natural spread between the 10-year note and 30-year mortgages. And so that normal spread is about 170 basis points. Back in the heydays of 23, right? Over here, we hit 5% in 30-year mortgages, and we hit 8% on, 5% in 10-year note, 8% in 30-year mortgages. And then gradually it declined. And currently, they're right back to spreads that are kind of normal, pretty darn close to 170 basis points. So that means as a mortgage professional, you need to watch what the 10-year note is doing, because the only way mortgage rates get better is the 10-year note has to move lower. I'm going to talk about key levels here in a few moments. Or the spread has to narrow beyond historical levels, get below 170. So it's pretty important to track. And by the way, to show you where we are now, if the 10-year note is at 4.25, and the spread is more like, is closer, with 30-year mortgage rates just above 6%. If the spread had not narrowed to near current levels, think if we just went back up to, if we went closer to that 300 basis points, we would be at 7.25, right, on 30-year mortgages, a lot further than we are now. If it were 250 basis points, we'd be 6.75. So, that spread that we've seen narrow, it's important that it stays intact. And I think it will, because of this idea that we're going to buy mortgage bonds and keep that spread narrow. You could see this is my mortgage market guide site, and we show this spread every day so you can kind of get an idea. In addition to the unbelievable growth that we're seeing in third quarter and the fourth quarter, we are also going to have a really nice tailwind, like Fred Flintstone, on refunds, upwards of an extra, up 20%, $491 billion worth of refunds. And this is going to hit between $60,000 and $400,000 earners, like the meat of the economy. So it's a really good thing. That's going to help. And so there's no chance of a recession anywhere in the foreseeable future. I put this in here before gold really got hammered, because I was going to joke and say, when charts go parabolic and they go to $5,600, that is like a bug looking for a windshield. And wow, I wish it waited a little bit before it fell off a cliff. But, that one I could see coming, a lot could. And so, gold's probably going to go higher, but I think it needs, it needs to chill out a little bit. It needs to consolidate, because it went from 3,000 to 5,600 pretty darn fast. And a lot of that's been central bank buying. And then on cue, right, as soon as the retail investor jumps in, that's when the sell-off happens. So it was amazing how the nomination of Warsh helped push it, because Warsh wants a strong dollar. Let's talk about rates, put a bow on this. So this is my mortgage market guide site. And you could see here on the right, mortgages, this is a 5.5%, the 5% coupon. We're hanging around, we're below this level right now, 100. Think of 100 as stopping pricing from getting better. It's above us. The only way rates get better is we have to push below it. And if we get above it, what will happen is this idea that resistance becomes support and vice versa. If we get above it, instead of 100 being a ceiling, it becomes a floor. And then it becomes not as good as rates could be, but about as bad as they can be. That's a good story. And then lastly, you could see my man Snoop. He's a little bit of a curmudgeon. Why? Because we got above 420, the Snoop line. 420 prevented rates from getting better all last year. And then you can see we bounced off it, bounced off it, bounced off it. It was amazing. When we pushed below it, it became a ceiling. Over here was really nice. I was really ecstatic. We got below 4% briefly, but we got back above, and then 4% couldn't hold. And then we went right back to 420, and then we pushed through it. We need the 10-year note to get beneath 420 to see meaningful improvement in mortgage rates. So that is a number I would be sharing with a client, with an opportunity, or anybody you're talking to this afternoon. At the same time, we approached 430 a couple times over the last couple of weeks. If we go above 430 and get comfortable, that would be bad. We would start getting dragged towards 450. But it looks like 430 wants to hold, at least for now. So we're right between 420 and 430, with the threat of going to 450, it goes lower, and then back to 4% if we go beneath 420. So it's pretty, like, for me, looking at the charts, it is like counting dots. I mean, painting circles, painting numbers. I mean, really, really simple where we are now. And so what you have to watch, in close to watch what Besant happens, what the Fed, what Besant does with rates, what fiscal policy, what Mr. Wash does with the Fed funds rate come June, the numbers, all that stuff we have to track together. And then finally, 2026 as the year goes on. I think 25 was certainly better than 24. I think 26 is going to be better than 25. I think Kevin Warsh is going to breathe a sigh of relief into the markets, that it's going to be embraced. I think Young, Besant, and Buffett, you got to watch those folks. They're getting it. They're betting on homes being sold and homes being built. I absolutely agree. Fiscal policy is just kicking in. I think it's a fantastic thing. Affordability is going to improve a bit, much more this year than last year. It's not going to be magical, but it's going to be better. Household formation exists. So there's just a lot to be excited about. And so in closing, if we're not connected on LinkedIn, that is my profile. I got 10,000 folks that follow me every day. I always keep nuggets. Connect with me. If you want to learn how I help banks and credit unions and lenders, let's connect. And then what I'll leave you with, guys, before I take questions, I just put a little link in here. If you want to take a little 2-week trial of our product, or you want to connect with me as a sidebar, we help a lot of folks, and I've been doing this for a long time. And I'm just grateful, Joe and Bill and you all, for the opportunity to chat with you today. So
The Hey, our pleasure as well, Bill. Thank you very much. I was trying to keep up. I was trying to write down some of the little isms that you had in there, right? A bug looking for a windshield, the dirtiest shirt or the cleanest shirt, the dirty laundry. The
yeah,
I like the way you weave a lot of those different things in to make it relatable, right? It's certainly a lot of information. We're all hoping for the best. We're all hoping for, any ray of sunshine that we can see that 2026 is going to be better, that there will be more activity, that there will be more homes built, all those different pieces you touched on. Buffett, I think that's very, very interesting, to see him putting $1 billion in on home builders. That's certainly a sign. And I think pretty much every American trusts his direction and where he's going, right? Because he's just
right.
been so smart for so long. So,
That's exactly right.
yeah, really good pieces there. And again, just a reminder here for everybody that's on, usually within a week's time, we're able to post this out onto our YouTube channel. So you can go back out, send any of your coworkers, let people know. There was a lot of detail, a lot of information there, a lot of good snapshots of slides that you could then go back and share with your teams as well. And again, I think a lot of folks have been very astute in the business over the last couple of years, Bill, to your point, paying attention, to the movement of the 10-year Treasury and the correlation, with 30-year interest rates. So, everybody's hoping to get it under 420, 410. We know that that's going to be a driver. And at some point, the refi activity will certainly start to increase. And, that's really the silver lining that everybody, I think, is hoping for. See a little bit of it maybe in 2026 would be terrific.
Yeah.
Good. So again, folks, thank you for attending. As we said, check out our YouTube channel. This will be posted out there. Go back and rewatch it. Please reach out to Bill. If you're not already a member, look at the mortgage market guide. Certainly something you want to pay attention to and follow. It's up to date. It's got the most current information and easy to understand as it was as Bill walked us, excuse me, as Bill walked us through this presentation here today.